What are self-storage cap rates? Cap rates can make or break a good investment deal. What's a good one? Why do some storage facilities sell for 4 caps versus others that are 8 caps? Understanding cap rates are the key to finding great deals, but is a high cap rate always a good idea? We're gonna break it down. By the end of this video, you're gonna understand what a cap rate is, how to evaluate a storage facility and determine the cap rate, and then how to go find deals using calculating cap rate on your investment. Okay, so what's a cap rate? If you're in the industry, you probably know what it is. If you're not, well, it's a term that's thrown around a lot, and this is a critical metric to understanding the performance of your real estate property. In self-storage, people buy storage for cash flow, period. We're in this business to make a return on investment, and if you have investors or if you are an investor, really the bottom line is, what's my return? So, cap rate is the first metric you really want to understand. It means capitalization rate. And the formula is this. It is the net operating income divided by the total price of the asset. That's a bunch of jargon, but what it really means is the profit that's generated from the facility divided by the total cost that you have in the facility or the property. And then it's a fraction or it's a multiple of that. So if you buy a property at $5 million and there's $500,000 of net operating income, that is a 10% cap rate. That means if you buy the facility with all cash, there's no debt involved with this equation. Remember that. That's a key thing to understand. This equation factors in all cash. So this is the return on investment or profit that you get if you buy the facility without any debt. And this is the net operating income, that is the profit, divided by the total cost of the asset, and that includes any closing costs, any improvements, what you call capital expenditures, anything you do to add on to the cost of the property, that is the denominator, the net operating income is the numerator, and that gives you your return. Cap rate can also be called the stabilized yield in fancy circles around Wall Street, and this is a key number. When you're looking at an investment, you want to know what is the cap rate when I'm buying the investment. This is going to tell you the grade of the asset or the quality of the return. That way you understand what you're getting into from the start. So how do self-storage cap rates compare to other commercial real estate assets? It's a great question I get asked all the time. And in the past, 20 years ago, self-storage cap rates were traditionally a lot higher than all other commercial real estate assets. You have the core 4, right? Office, industrial, retail, apartments. That's traditional commercial real estate, and now, recently, self-storage has moved into that category where it's more popular. It's a traditional asset now. No longer are people just buying storage facilities as a land play, meaning they're gonna tear it down and build something of higher use. Now in the commercial real estate markets, self-storage is the asset. It is the highest use. So cap rates have gotten compressed, meaning they've gotten lower. So returns for investors have dropped on storage facilities at a institutional or a large market scale. So cap rates now typically run anywhere between 5 and 7%. This is for nice storage facilities, this is for quality, this is for good regions of the country or good demographics. These are the returns you can expect by a cap rate for those types of facilities versus rural, small, beat up, damaged facilities. You'll be at 8, 9, maybe even 10 on your cap rate. So it's real important to understand what type of asset and what area you're in order to determine the cap rate. And that leads to my next point. What are the key influences on cap rate? Well, it's location. If you're in the heart of Los Angeles or New York City, you are going to have one of the lowest cap rates in the country. Those are the highest demand markets in the US. And that's going to command a 4 or 5% cap rate, a very low return on investment. If you're lucky, you can get those. And then if you're in the middle of Nebraska, where there's really not a lot of people, not a lot of jobs, not a lot of housing, then you're going to have a very high cap rate because there's not as much demand for that product, and investors don't want to invest in something where there isn't the potential for that demand. So it's really important. 1, look at the location. That's going to determine the cap rate. 2, what's the quality of the asset? Is it a nice brand new 3-story polished shiny facility that is modernized and updated? That's going to command a low return, a lower cap rate. Or it is a metal building in the middle of a cornfield. that has roof problems and drainage issues and leaks, that's gonna command a high cap rate. This gives you an idea of the spectrum of return on investment by using cap rate as the metric, where good quality brand new facilities, low cap rates. Old, defunct, outdated facilities, high cap rates. Current market trends have affected cap rates in a dramatic way. Like I mentioned, in the past, storage facilities were just a land play where investors would tear them down and put something else up in their place. Now, self-storage is a durable cash flowing business. 1 in 10 Americans have a self-storage unit and it's growing. That is a very safe place to park money because there's a diversified stream of income, meaning there's lots of tenants that keep coming in and out of the facility that keep providing more consistent cash flow. It's like the Amazon model of real estate. Once they buy, you just keep the subscription model and they keep paying month over month, letting that card debit or auto pay, and you keep getting consistent income. This is attractive in the market now. Due to the Amazon effect on the retail side, a lot of big box retailers are going out of business. A lot of office buildings are sitting vacant due to the COVID effect and people working from home. So investors like that safety in self-storage, and that's what's dropped the returns. More capital flowing to the asset class versus the traditional asset classes. And the trend isn't going away. People continue to lease storage up and investors keep buying it. That's the opportunity in the industry, and that's why 15 years ago I decided I want to get into self-storage. I can see it emerging as a good property asset class, and I was in front of the curve. Now with the trends, it's a lot more competitive in the industry, but that's an opportunity too, because now there's big buyers that will pay top dollar for your facility. And this is what I'm hoping for when I sell a lot of mine, that these institutional buyers like the attributes of a storage facility and they're gonna pay a low cap rate, meaning a really high price. So do you buy a storage facility that has a really high cap rate? Well, in a perfect world, yes, you want a storage facility day one to have a huge cap rate. That way you can have a large return, a large profit on your storage facility. But be careful, it could be a red flag. I've looked at a lot of properties that have a high cap rate. In this market in 2025, 7, 8, 9, 10, these are high cap rates where traditionally cap rates were really low. Now, these cap rates can be alluring, but they can be a trap because you get yourself tied up in a property where that seller can't sell, the business is declining, people are leaving the area, and there's a ton of deferred maintenance. You're gonna have to go in there and end up spending $500,000 or $1 million to update the facility. So don't get fooled by a nice cap rate on the acquisition or on the buy. You want to look at the long-term value of the facility. And that leads me to the next point of what is your stabilized cap rate? This is the real number to look at. It's not how much the cap rate of return is the day one you buy the storage facility. That's really important, but it's what can I stabilize it to? And when I mean stabilize, it means over the first 2 years of the business, how can you make improvements? What can you do to physically improve the property versus managing the property and increasing your rents, lowering your expenses? What is going to be that stabilized cap rate once you've owned it for 2 years? That's the metric we look at. And if we can achieve an 8.5% cap rate after 2 years of owning a storage facility, even though we might have bought it at a 4% cap rate, we created more net operating income, which is more profits. And that's the number that myself and investors are looking at because that's going to create the value add and the long-term returns. And ideally, rents keep increasing, and over time, as long as you don't keep investing more money in the storage facility, your cap rate's going to continue to go up. But the sweetest part is after you've increased the cap rate, you can go back and refinance the storage facility, and it really depends on interest rates. But if interest rates are lower than the cap rate, 6, 7, that's what they are right now, but you're at an 8.5 or 9% cap rate, now you can refinance and be able to pull out some money that you invested in the storage facility. So you can now borrow at 6 or 7%, but the property's yielding you 8 or 8.5 or 9%, and that's where you make your profits each month. That multiplies dramatically when you borrow against the facility. Now I'm getting complicated with this, but it's really important just to remember these numbers. Know your net operating income. Know the cost of the facility, and then how do you stabilize it? What will be that total cap rate after you've done all your improvements? This is the key metric to look at in order for you to build and create value. So the question is, now that I know cap rate, how do I go find deals? Well, this is the secret. This is what I'm going to talk about in the next video and in many videos in the future. How do you actually go find good properties where perceivably on the market there aren't any good cap rates? Well, that's where we use what we just learned. We don't care what the cap rate is day one, we care about what the cap rate is 2 years from now, after we can make the improvements. And that's when we look at what is the demand, where's the location, what's the quality of the asset, what market is it in, and are there people that really need storage? Is there housing, apartments, and the need for that product? If there is, that's where we can find deals that may not look good on the surface, but over the long haul, are a cash cow and they will keep growing over time. So don't be discouraged if you can't find a good cap rate with marketed properties that are listed for sale. The real secret is finding properties that you could add value and have potential. That's going to get you a good cap rate if you're patient. So now you know cap rate, the most important metric in commercial real estate investing. In the next video, I'm going to go over how to actually analyze a self-storage deal. And if you're interested in calculating the returns on a facility yourself, go to my website, patriotholdings.com or patriotcalc.com. And we gave you a tool to put your storage facility or a potential opportunity in the calculator, and it's going to show you exactly what that cap rate is based on the price that you're paying. Click on the link below, and let's jump into diving in the numbers.